Once again, ladies and gentlemen, boys and girls, and children of all ages, you are now tuned into the Investing Show. As always, this is your gracious host, the Prince of Investing, Prince Dykes, coming to you guys and girls live all the way from the beautiful city and state of Denver, Colorado. Don't forget to hit that like, subscribe, comment, and share button. And as always, I thought I had my microphone on there, but as always, don't forget to hit that like, subscribe, comment, and share button. And as always, I don't have a lot of time. I definitely know you guys and girls don't have a lot of time, so we're going to jump straight into it. So today we're going to play from the Federal Reserve. The Federal Reserve today put out their unemployment. They're going to talk about unemployment, inflation, and interest rates. We're going to listen to the Federal Reserve, and I'm going to give commentary as the Federal Reserve is speaking. This is Mr. Jerome Powell. These are the people that control the interest rates, which as interest rates rise, they're trying to combat inflation. As interest rates rise, this affects the interest rate that you're going to get on your bank account, all of the good stuff, your bank account, not your bank account, but your savings account, your bank account, all of the great stuff. So without further ado, ladies and gentlemen, we're going to go ahead and we're going to play Mr. Jerome Powell. Here we go.
At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us, maximum employment and price stability. Today, the Federal Open Market Committee kept interest rates near zero and maintained our asset purchases.
So right here, they said they kept interest rates near zero, which is between 0.25, what they have them at right now. So they're saying they kept them at 0.25, and they're keeping their asset purchasing program, aka pumping money into the market.
These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. Widespread vaccinations, along with unprecedented fiscal policy actions, are also providing strong support to the recovery. Indicators of economic activity and employment have continued to strengthen, and real GDP this year appears to be on track to post its fastest rate of increase in decades.
So he's talking about the GDP, the gross domestic product, how many things we are producing. So here's saying that, hey, the GDP is looking good. The only thing they're struggling with right now is unemployment numbers. They're saying inflation is kind of going up, but they're struggling with unemployment numbers. That's why they're keeping the interest rates near zero.
Much of this rapid growth reflects the continued bounce back in activity from depressed levels. The sectors most adversely affected by the pandemic remain weak, but have shown improvement. Household spending is rising at a rapid pace, boosted by the ongoing reopening of the economy, fiscal support, and accommodative financial conditions. The housing sector is strong, and business investment is increasing at a solid pace. In some industries, near-term supply constraints are restraining activity. Forecasts from FOMC participants for economic growth this year have been revised up since our March summary of economic projections. Even so, the recovery is incomplete, and risks to the economic outlook remain. As with overall economic activity, conditions in the labor market have continued to improve, although the pace of improvement has been uneven. Employment rose 419,000 per month on average in April and May, with the leisure and hospitality sector continuing to post notable gains. Employment in this sector and the economy as a whole remains well below pre-pandemic levels. The unemployment.
So right here, he's speaking about hotels and leisure, places like your Six Flags, your hotels, your restaurants, things like that. He's saying, hey, they're getting better, but they're not at the level they were before the pandemic. That's the hard area of unemployment. This is why they were keeping interest rates at 0 to 0.25.
Rate remained elevated in May at 5.8%, and this figure understates the shortfall in employment, particularly as participation in the labor market has not moved up from the low rates that have prevailed for most of the past year. Factors related to the pandemic, such as caregiving needs, ongoing fears of the virus, and unemployment insurance payments, appear to be weighing on employment growth. These factors should wane in coming months against a backdrop of rising vaccinations, leading to more rapid gains in employment. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate standing at 4.5% at the end of this year and declining to 3.5% by the end of 2023.
So right here, you can look at the unemployment projection that they're showing. They're showing actual unemployment. They're seeing the spike go up. We had the pandemic, and then their projections of it dropping all the way down until they get to 2023. So they're looking at by the end of the year, we should be at 4.5 unemployment, and we're going to see if we can keep those numbers up. This is very important to keep in mind because inflation is growing back. Things are opening up. We're making money, but unemployment is not dropping at a level to where they want to raise interest rates. So a key indicator as an investor, as you see unemployment drop into the Fed's zone, you can see them starting to want to crank up interest rates. And I think when they start to crank up interest rates, this is going to be your indicator of cooling off the stock market and cooling off definitely the housing market.
The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on lower wage workers in the service sector and on African Americans and Hispanics. Inflation has increased notably in recent months. The 12-month change in PCE prices was 3.6% in April and will likely remain elevated in coming months before moderating. Part of the increase reflects the very low readings from early in the pandemic falling out of the calculation, as well as the pass-through of past increases in oil prices to consumer energy prices. Beyond these effects, we are also seeing upward pressure on prices from the rebound in spending as the economy continues to reopen, particularly as supply bottlenecks have limited how quickly production in some sectors can respond in the near term.
Now, what he's speaking about is the supply bottleneck. He was saying as we see this uptick in spending, when people are starting to make more money, people are getting stimulus checks, PP, whatever they're doing, people are getting more money, and the demand is increasing so fast that we're creating chip shortages. We're creating toilet paper. Remember that time we had the toilet paper? We're creating these bottlenecks to where production cannot keep up, supply cannot keep up with demand. We're seeing these crazy prices, things like that. That's what he's speaking about there.
These bottleneck effects have been larger than anticipated, and FOMC participants have revised up their projections for inflation, notably for this year.
Right here, they're expecting inflation. FOMC is the Fed saying they're expecting inflation to rise some more this year. Who benefits from inflation rising? Banks. When interest rates start to increase, you're going to see banks. I'm sorry about that. I meant when you see interest rates go up, banks. When you see inflation go up, this when you start to see places like your Amazons, your retailers, consumer discretionary. So you're looking at things like the Federal Reserve is thinking they're saying inflation is going to rise, and the companies that benefit from this is consumer discretionary places like your restaurants, places like your Amazons, your Walmarts that can raise their prices. So that's an eyeball to keep there.
As these transitory supply effects abate, inflation is expected to drop back toward our longer-run goal, and the median inflation projection falls from 3.4% this year to 2.1% next year and 2.2% in 2023. The process of reopening the economy is unprecedented, as was the shutdown at the onset of the pandemic. As the reopening continues, shifts in demand can be large and rapid, and bottlenecks, hiring difficulties, and other constraints could continue to limit how quickly supply can adjust, raising the possibility that inflation could turn out to be higher and more persistent than we expect.
So right here, what he's saying, when he showed the chart, he was saying we're thinking we're going to have a spike in inflation, and then we expect inflation to go back down. So they're saying that if we continue to get these bottlenecks and supply issues, we can go into not hyperinflation, but inflation to be higher than what they expected. So they're expecting inflation to go up and then to start to fall back off. But in the short term, for the rest of the year, they're expecting this peak in inflation. Consumer discretionary is the gem that I hear.
Our new framework for monetary policy emphasizes the importance of having well-anchored inflation expectations, both to foster price stability and to enhance our ability to promote our broad-based and inclusive maximum employment goal. Indicators of longer-term inflation expectations have generally reversed the declines seen earlier in the pandemic and have moved into a range that appears broadly consistent with our longer-run inflation goal of 2%.
So they want
Yes,
inflation
we
at
saw signs that the path of inflation or longer-term inflation expectations were moving materially and persistently beyond levels consistent with our goal. We'd be prepared to adjust the stance of monetary policy.
So all that fancy terminology is saying that, hey, we want inflation to be at 2%. Long term, if inflation goes over 2%, we're going to raise interest rates. That's all he pretty much said. Monetary policy is when the Federal Reserve plays with the money. Fiscal policy is when Congress passed legislation, all of the good stuff like that. All right.
The pandemic continues to pose risks to the economic outlook. Progress on vaccinations has limited the spread of COVID-19 and will likely continue to reduce the effects of the public health crisis on the economy. However, the pace of vaccinations has slowed, and new strains of the virus remain a risk. Continued progress on vaccinations will support a return to more normal economic conditions. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. As the committee reiterated in today's policy statement, with inflation having run persistently below 2%, we will aim to achieve inflation moderately above 2% for some time so that inflation averages 2% over time, and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect that it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time.
Now they're saying we're going to keep interest rates at 0 to 1.4% until we have maximized unemployment, meaning unemployment has dropped, and that we are keeping inflation at 2% consistently.
As is evident in the SEP, many participants forecast that these favorable economic conditions will be met somewhat sooner than previously projected. The median projection for the appropriate level of the federal funds rate now lies above the effective lower bound in 2023. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a couple of years from now.
Their projections
More important than any forecast is the fact that whenever liftoff comes, policy will remain highly accommodative. Reaching the conditions for liftoff will mainly signal that the recovery is strong and no longer requires holding rates near zero. In addition, we are continuing to increase our holdings of Treasury securities by at least $80 billion per month, and of agency mortgage-backed securities by at least $40 billion per month, until substantial further progress has been made toward our maximum employment and price stability goals.
Right here, when they're saying 80 billion and 40 billion a month or whatever, this is money they're pumping into the market. They're telling they're buying treasury bills. When the Federal Reserve buys something, they're pumping money into the market. When they sell something, they're kind of pulling the money out, right? So keep that in mind. So right here, they're talking about the money they're pumping into the market. That's still going. They're going to keep inflation rates at 0 to 1.4. This is very important for somebody like me who is at a 2.75 mortgage. Should I not reinvest, but should I refinance my mortgage? What do I think interest rates will be? The Federal Reserve is saying until we have maximum unemployment, meaning unemployment numbers drop, and then we also need to have inflation sitting at 2% consistently over the long term, they're going to leave interest rates alone, meaning that interest rates could possibly drop into the future.
The increase in our balance sheet since March 2020 has materially eased financial conditions and is providing substantial support to the economy. At our meeting that concluded earlier today, the committee had a discussion on the progress made toward our goals since the committee adopted its asset purchase guidance last December. While reaching the standard of substantial further progress is still a ways off, participants expect that progress will continue. In coming meetings, the committee will continue to assess the economy's progress toward our goals. As we have said, we will provide advance notice before announcing any decision to make changes to our purchases. On a final note, we made a technical adjustment today to the Federal Reserve's administered rates. The IOER and overnight RRP rates were adjusted upward by 5 basis points, in order to keep the federal funds rate well within the target range and to support smooth functioning in money markets. This technical adjustment has no bearing on the appropriate path for the federal funds rate or stance of monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to support the economy for as long as it takes to complete the recovery. Thank you. I look forward to your questions.
All right, that is Jerome Powell, the Federal Reserve Chair. There, he decided to keep interest rates at 0 to 1.4 to 0.25 until further notice, and they pretty much said, "Hey, we're going to keep these here until our interest rates start to drop and our unemployment gets back up." So they know, and they're also giving you a good indicator on inflation. They're looking at inflation to be a little uptick more than what they previously expected, meaning that's a key sign for me as an investor. Now I'm going to look at things like consumer discretionary, and I'm also going to hold off on maybe refinancing my house. Maybe I can get a lower interest rate in the future, or interest rates may stay the same because I always keep good credit, knock on wood. So anyway, ladies and gentlemen, hope y'all got something out of that. Let me see what y'all say in the comments before I get out of here. Brock N, what's going on, Brock N? Okay. Oh, then I got my guy Pete for Life. He's out there in Phoenix, Arizona. He says, "Hey everybody from Phoenix. Hey Prince, what's going on, Pete for Life?" And that's my guy there, Al Will. What's going on, man? What's going on? Thank you for checking in. So yes, ladies and gentlemen, we are live right now on YouTube and Facebook and Twitch. So follow us on all those platforms. And yes, you catching the playback on Spotify, iTunes, and Audible, all that other great stuff. Thank you for checking that out as well. Hopefully y'all got something out of that. That's the Federal Chair, Jerome Powell. And to the next video, podcast, cartoon, or whatever else crazy you see me doing around the globe. Peace, be safe. I'm out. Thank you.